뉴욕나우. 안녕하세요. 글로벌 시장에서 통하는 투자법을 알려드리는 뉴욕나우 한국경제신문 강영현입니다. 오늘은 더그페타 Bca리서치의 수석 미국 투자 전략가와 미국 시장에 대한 이야기를 해봤습니다. Bca리서치는 글로벌 리서치 기관인데요. 특히 거시적인 데이터를 중심으로 시장을 분석하는 데 강점을 가진 곳으로 알려져 있습니다. 오늘 인터뷰에서는 올 들어 변동성이 커진 주식시장의 앞으로의 방향성과 함께 올해 가장 주목할 만한 리스크 요인이 무엇인지 들어보겠습니다. 또 금리 인상 우려로 기술주가 특히 조정을 받고 있는데요. 이 같은 흐름이 이어질지에 대해서도 의견 나눠보겠습니다.
I expect another good year for the stock market in the United States and for the S&P 500, in which the S&P 500 rises by high single-digit percentages or even low double-digit. So, will we get a fourth consecutive year of greater than 10% gains? I don't know, but I certainly expect, high single digits to low double digits. And for someone who is trying to decide on asset allocation, on do they want to be in cash, do they want to be in bonds, do they want to be in equities, I'm confident that equities will produce positive excess returns over what could be earned in cash or in treasuries. So at BCA, we very much want to overweight equities within a multi-asset portfolio in 2022. I don't know, and I'll tell you, we don't make point forecasts at BCA, but let me just talk through sort of the positives or the tailwinds for the United States and potentially the tailwinds for the rest of the world, ex the United States. One thing in the United States' favor in terms of growth relative to the rest of the world is that the fiscal response, the money that was sent by the federal government to private entities, households, businesses in the United States was far greater than it was in the rest of the world. So that for the US, as incredible as this sounds, 25% of a year's GDP was sent from Washington, D.C. to households and businesses. No other major economy globally received support to that degree. So in that sense, the United States has a greater tailwind than other economies did. And I think it's important to recognize that that tailwind, only part of it has been felt to this point. United States households have, we estimate, about $2.3 trillion of savings that they would not otherwise have had if we hadn't had a pandemic. And that's sort of an incredible thing to think about. That US households in the aggregate are more than $2 trillion better off than if we hadn't had the worst global public health crisis in a century. And that is testament to how much money was sent from Washington, D.C. to households. To the extent that other economies don't have that, again, that gives the United States a tailwind, and that money hasn't been used yet, right? So the fiscal transfers from Washington, D.C. to households are over for the most part. But that money still remains. And we do expect that it's going to be deployed, and that will support consumption in the United States, and therefore it will support US GDP growth. On the other hand, okay, for the rest of the world ex-US, if the pandemic were to more or less go away in 2022, if we achieve endemicity, where large swaths of the global population has either been vaccinated or has already had the illness, and therefore it becomes something more akin to the flu or a very bad cold, that would argue for the rest of the world getting a boost relative to the United States, because of the United States is a comparatively closed economy, in that trade with the rest of the world doesn't matter that much to the United States. Much more forward-facing economies, much more open economies to trade are much more dependent on how the global economy is doing. If COVID really, just becomes an annoyance instead of an acute concern, then the global economy should do better, and the US should get less benefit from that than the other major economies. As I alluded to with the savings having stacked up and not having been spent, we don't think investors should worry that because the flows of stimulus have stopped, that U.S. consumption is going to abruptly stop growing or stop. The consumers are going to stop spending more than they otherwise would, than they would if the U.S. economy were going to grow at 2% adjusted for inflation in 2022. We expect it's going to grow much faster. And we do think consumption is going to be a very important driver of that. So while the flows have stopped from Washington, D.C., they're still there. People didn't use them up. And not just, when we talk about that $2.3 trillion of excess savings, that mostly benefits the bottom 2/3 of households in the United States in terms of income, because they were the ones that were eligible for the full distributions from Washington, D.C. The really wealthy end of the continuum, those households have benefited tremendously from a record increase in household net worth over the 7 quarters ended in the third quarter of 2021. And I think it's pretty clear that the 8 quarters through the fourth quarter of 2021 will also be a record. And that's significant because the worst quarter ever on record was the first quarter of 2020. We've had this tremendous bounce back because of the tremendous surge in stock prices, because of bond prices rising a lot, and because home prices have really surged. So it's generally viewed that the top 10% of the wealth distribution in the United States has most of the stock market exposure. So this top decile has benefited tremendously as well from what's going on in financial markets. So at the end of the day, what you have is the entire continuum of United States households. Inequality is real, but in this case, everyone has benefited from the pandemic, and that we think that will keep consumption growth in 2022 well above its trend. I think so. If you can, when I think about corporate performance, I think about growth in earnings per share. Right now, the consensus of analyst estimates, the bottom-up consensus for all the companies in the S&P 500, is for earnings per share to grow close to 9% in 2022. I think they can do that because it looks to me like the consensus estimates for the first half of 2022, for the first quarter and the second quarter of 2022, are too low. And I say that because the analyst consensus expects that earnings per share for the S&P 500 to be lower in the first quarter and the second quarter than they were in the fourth quarter that's being reported right now, and the first quarter of 2022 to be below earnings for the third quarter of 2021. That's a really unusual phenomenon, that earnings would fall quarter over quarter unless we were having a recession. I don't think there's a recession anywhere close to on the horizon when I'm talking about how I expect, and all of us at BCA expect, and indeed the entire economist consensus expects, that the U.S. is going to grow well above its trend level. Right? That's not a recession. So it seems like these next 2 quarters of earnings expectations are way too conservative. So I do think, yes, we can see corporations growing their earnings in the S&P 500, growing their earnings at around 10% in 2022. And that gets back to my expectation that we can have high single-digit, low double-digit increase in S&P 500 prices in the index, because I don't expect that we are going to see the price that investors pay for stocks, the price that investors pay for each dollar of earnings, the PE ratio, to contract in any meaningful way in 2022. Now, admittedly, they're paying a lot right now. It's about 22 times forward earnings estimates. That's very, very high. But we are in an environment where it looks like equities are the only asset class that can provide positive inflation-adjusted returns, positive real returns. It's become something that we've mentioned a lot in the United States over the last 6-7 years, TINA, TINA, which is an acronym for there is no alternative. And I think against that there is no alternative backdrop, that there will continue to be demand to own stocks, and that therefore that multiple is going to be able to hold up. We're not looking for it to expand, to get bigger, but we don't think it's going to contract. So I do think, and all of us at BCA think, inflation will remain elevated relative to what we have known over, certainly the last 10 years since the global financial crisis, but even, really the 20 years, the last 20 years, right? We've seen low and declining inflation in the United States and really everywhere around the world. So we do think it's going to be much higher than what we've seen in that 2% target that central banks have sort of settled upon around the world. But we do think it'll come down from here. That 7.2% that you mentioned in December year over year, we certainly don't think that is going to continue across all of 2022. So we do expect it to decline, but again, remain well above that 2%. I would think anywhere from 3 to 4% in 2022 is a reasonable expectation. That's really elevated. What remains to be seen, what I think the real wild card is for financial markets in 2022, is what is going to happen to inflation. What is the path at which it's going to come down, by which it's going to come down, and then how will the Fed respond to it? If we were to see inflation come down very, very slowly, let's just pick numbers out of the air. 7.2 to, I'll call that 7.25 to 6.75 to 6.5 to 6.25 to 6 across the first few months. I think the Fed would speed up the rate hikes beyond what they're anticipating right now, because I think the Fed is looking for, something like I outlined, going down to 3 to 4%, or around that 3.5% JP Morgan target. And if the economy would go there sort of on a straight line, right? If we just go gently from 7.2 to, again, I'm making a number up, 3.2 at the end of the year. And if we went down by, say, 30 or 40 basis points, 3 or 4 tenths of a percentage point every month, then I think the Fed would say, okay, you know what? Inflation's moving in the direction we want it to move. And therefore, we don't have to go crazy with the rate hikes. Let's do 3 or 4 25 basis point hikes across 2022, and we'll end 2022 with the Fed funds rate at 1 or 1.25%. And we'll see from there. That's sort of a benign scenario. And I think that's the one that markets are basically looking for now. But you have days like today where you would think, all right, maybe the market is telling us that it thinks, wait a minute, the Fed's going to have to move faster than that the Fed is going to have to hike rates in a way that is more disruptive for financial markets and for the economy. I don't think we have anywhere near enough evidence to conclude that yet. And I would expect that markets will settle down like they have been. You'll have a couple of days of concern, and then they'll ease up again, and sort of TINA will take control again. But you're right to focus on inflation, because I do think that's the one big unknown. None of us know exactly what's going to happen with that. I had mentioned before, if we see the pandemic become less serious, that would be good for global growth. Well, also, if the pandemic becomes less serious, that should help tamp inflation down. If China doesn't have to reduce activity to enforce its zero tolerance policy for COVID, or if the effects of COVID become mild enough that it doesn't need a zero tolerance policy anymore, then you can have more and more people loading ships at ports in China. And that should help relieve some of the supply bottlenecks that have been driving prices higher. So I suppose, a lot of this, we're all tired of talking about it and living with it after 2 years. But I suppose much of what is going to happen economically and in markets in 2022 depends on the path of the pandemic. Sort of adding on to our last question, I hope that by late summer, early fall in the Northern Hemisphere, by the end of this, in the third quarter, that we will start to see the supply chain pressures abate. And the key to that is either the COVID-19 becoming less serious, or if we ramp up production of drugs enough that we can get those drugs around the world. And in the case of the Pfizer pill, this has, in clinical trials, produced tremendous results. And even the scientists at Pfizer said the success is well beyond our wildest dreams. And in fact, the FDA halted the trials early because they said this is so good that we are hurting humanity if we don't let it be used right away. They have enough confidence from the really robust results from the trials that this is something that could turn the tide. And I think it's important globally when we think about supply chains, because while the Pfizer and the Moderna vaccines apparently work very well, and apparently they're able to defend against Omicron as well, right? It looks like that now. So they've been a wonderful development, a tremendous achievement for humankind. However, they have to be stored and transported at something like 50 or 60 or 70 degrees Fahrenheit below zero. That is a big logistical challenge, and it's really difficult for getting it to the entire globe, to getting it to all of the developing world, because you've just got greater infrastructure challenges in the developing world. You may not be able to refrigerate the stuff as easily when you're transporting it. You may have to deal with rutted roads and networks of roads that don't cover the entire population in the country. If we were able to send, foil sealed packets of pills that don't have to be chilled, that don't need any, really particular challenge in handling them, and that people within the first 5 days of showing symptoms could take this pill and have nothing more than a bad cold or a very mild flu, that would be transformative. And I think that would really matter a lot for the supply chains, because now everybody would be able to go back to work, right? You would have factories able to operate at full capacity. You would have ports able to operate at full capacity. You would have, surface networks, road and rail being able to operate at full capacity. So again, the course of the disease matters, whether there are variants, whether variants emerge that can evade the vaccines and the medicines that we have. And can we ramp up production of these medicines rapidly enough to get them out to the whole world, such that we really can see the tide turning with the pandemic by the second half of 2022, in which case I do think you'll see many of these logistical pressures ease quite a bit, and that should resolve these supply chain problems and really help take inflation off of the boil. I think that seems like right. That seems like a good ballpark estimate that, yes, we'll get 100 basis points of rate hikes in 2022. But I don't think investors should consider that a certainty. It is, the Fed keeps saying that it is data dependent, and I believe the chair and every other, FOMC voter or regional president who says that. So if inflation is, say, 5% at the middle of this year and doesn't look like it's slowing in any appreciable way, it just kind of gets stuck in the 5s or the 6s, then instead of hiking at the end of every quarter, perhaps the Fed hikes at every meeting. The FOMC has 8 scheduled meetings a year. So, you could get 4 hikes if you hike every other meeting. Well, maybe it'll hike at 7 of the 8 meetings, all of the meetings after January. And there's no rule that says it can't go by 50 basis points or 75 or 100 basis points. So, while I think 100 basis points is a reasonable estimate, that estimate is based on my expectation that inflation is going to abate this year as the pandemic becomes less acute, and we are able to get goods flowing around the world more easily than we have been so far. If something about that story changes, then I do think we should expect more than 100 basis points of hikes in 2022. I do think there's a possibility because the Fed has been guiding us to that possibility. Now, it seems like it's sort of walked back the expectation that investors started getting after the December minutes, the transcript of the December minutes was released, that the Fed might do QT as along with the first rate hike. It seems like the Fed speakers since then have been trying to walk that back a little bit. So our bond team at BCA figures that we'll have 2 rate hikes before the Fed begins reducing the size of its balance sheet, and that additionally, it's not going to reduce the size of the balance sheet by selling the assets it holds. It's simply not going to redeploy the proceeds from the securities it holds when they mature. And what they've been doing to this point is the 120 billion a month. I guess they've been buying 80 billion of treasuries, 40 billion of mortgage securities. That when something, so they've been spending 120 billion dollars of new money every month. But then when a security that it holds matures, it also takes the proceeds from that maturing bond and uses those proceeds to buy more bonds. So it was keeping what it already had constant and then adding 120 billion to it every month. Now that quantitative easing is ending, for now projected to end in March, but it may well end. They may well announce in another week and a half when they meet that it's ending, now in January. We don't think they're going to be selling the stuff they own. They're just going to be not rolling over the proceeds from maturing securities, which implies a pretty gentle pace of the quantitative tightening or the reducing of the size of the Fed's balance sheet. And as such, we don't expect that is going to have any meaningful impact on financial markets. We'll see what happens once the Fed actually begins to try to sell some of the stock of bonds that it currently owns and how fast it would do that. Perhaps that will prove disruptive. But markets saw this once before. We do have some practice. The idea of tapering, of slowing down quantitative easing, really roiled markets in the summer of 2013, the taper tantrum. I think we're past that now. Markets have handled the notion of tapering pretty well, a faster tapering, a faster end of the purchases. And I do think they won't have much of a problem with simply letting the proceeds from the maturing securities roll off. Again, well, I'll tell you, when we think about changes in the size of the Fed's balance sheet and purchases of new securities or letting old ones mature or even selling some of the securities that it owns, we think its most powerful tool is adjusting the level of the Fed funds rate. And that therefore rate hikes are much more important for the economy and for markets than however it chooses to manage the balance sheet going forward with quantitative tightening. We're really focused on the rate hikes because we think those are much more important. Of course, I don't know. I'm not an epidemiologist, and right, no one has known what's going. Even the epidemiologists haven't known what was going to occur with COVID-19. At least in the United States, Omicron looks as if it is merely causing delays in opening. That it is causing us sort of to push back the date when full activity resumes in the United States. But I mentioned before, from what we know now, the available vaccines do provide a lot of protection against Omicron. And we're also seeing that, when people get infected with the Omicron variant, it does not appear to be as serious as what we saw at the beginning or what we saw with the Delta variant. And a way that we're able to track that quantitatively is that we've seen daily infection rates 3 and 4 times the previous peak. And we've gotten into the 800,000s of people per day. I don't think we were ever above 250,000 in terms of a 7-day average at the previous peak in Delta. And I further say, I think it must be 1 million Americans today are getting infected because not everyone gets tested. If you're asymptomatic, why would you get tested? If you are testing at home, you're probably not reporting that to a state agency. I don't even know quite how you would do that. And finally, tests are being rationed because we don't have that many tests. My mother's in southeastern Pennsylvania. The practice that she goes to, the physician practice that she goes to, they are reserving their available test kits for people who have really severe symptoms. Okay, so all of those things together make me believe that for this last week or 2 weeks that we've been seeing 600,000 to 800,000 a day in terms of that 7-day moving average, it must be a million. We aren't seeing anywhere near the pickup in hospitalizations, right? So the hospitalizations are about at the rate that they were with Delta, but 3 to 4 times as many people are being infected now. So it does look like Omicron is much less serious, and that there is a real resistance in the United States to going back to full lockdown measures. Around the country, public school districts are standing on their heads to keep the schools open. Now, it does seem to be different countries have different tolerances for lockdown measures. BCA is based in Canada. Canada, in both Ontario and Quebec, the restrictions have been much more onerous than they have been in the United States with Omicron, just as they were all last year. Australia, from what we learned from the Australian Open, when the top-seeded player tried to play without being vaccinated, Australia has pursued really stringent restrictions. But even continental Europe had pursued more stringent restrictions than the United States. It seems like there isn't an appetite for that anymore. And that around the world, governments are concluding that we are closer to endemicity, that this infection is endemic. It's going to be around like the flu or the common cold, and we have to learn to live with it. If that continues, then we are not going to see the lockdowns or the shutdowns that really cripple economies. A long-winded answer to your question, but I think all of that is important for trying to assess, does Omicron matter for financial markets? And for now, it really looks like it matters a lot less than Delta did, and that Delta mattered even less than the initial wave. So that, okay, I think it looks like we're going to see periodic surges. But if the seriousness of the disease declines with each of those surges, then we're just going to get on with it. And therefore, reopening will more or less be possible as scheduled. It may be delayed by a month or two, but I think now the view in the United States is that the show must go on. And you know what? If it's true that 1 million people are being infected every day, there are only 330 million of us. That can't go on too long until you get everybody, unless we can get this 3, 4, 5 times. So I do think we are getting real close to endemicity, and it seems like they're concluding that in the United Kingdom as well. And I would expect that that's going to become the view sort of around the world, and that therefore reopening will more or less proceed on schedule. It certainly looks like they're going to continue to rise at an increasing rate purely from supply and demand, that there's way more demand than supply. And businesses want workers, but there aren't that many people who are raising their hands saying, I want to work. So prices have to go up then if demand exceeds supply. So it seems like we're going to continue to see workers with leverage that they haven't had 40 years in this country. Really, the election of Ronald Reagan really signaled a steep decline in labor's prospects that has continued for 4 decades. Does that matter all that much for stocks, or is that going to be deadly for corporate profit margins and for stock returns? I think the jury's out on that one. The more that wages go up, the greater an incentive that a business has to try to automate its processes, to try to use technology to replace human inputs. Those businesses also have an increased incentive to offshore as much of the labor inputs as they can. Now, COVID has shown that there are risks to global supply chains that perhaps weren't fully appreciated. But Mexico is not so far from the United States. And logistically, it's a lot simpler to bring something overland from Mexico than it is to navigate these global supply chains and blockages at ports so that, all right, if the UAW wins big against John Deere, we just may see more John Deere equipment coming from Mexico. If Kellogg's workers, their wages are on a path that Kellogg's doesn't believe its shareholders can stomach, then we might see a lot more cornflakes coming from Mexico. So I do think there's something of a self-limiting effect for wage gains, because as they get stronger and stronger, businesses have a stronger and stronger incentive to seek alternatives. And it looks to me like there's plenty of capacity to use those alternatives. So this one, I should say at the outset, my colleagues do not share my view on this one. I seem to be in the minority at BCA, but it is my view that the notion that tech stocks are especially vulnerable to rising interest rates has gone way, way too far. And in evidence, I just say, look back from 2009 to today, and you will see that there is not a consistent inverse relationship where interest rates rise and tech stocks underperform the market. What we have seen since 2009 is that tech stocks have done well really in all interest rate weathers, but that before 2019 and the pandemic, there was a direct relationship between tech stock multiples, relative tech P ratios relative to the overall S&P 500, and interest rates. So that before 2019 through 2018, when rates rose, tech's relative multiple tended to rise. And when rates fell, tech's relative multiple tended to decline. Now, look, you always have to, when looking at past, say, well, what could be different this time? It seems like markets have gotten very, very carried away with a strong inverse relationship, a strong sporadic inverse relationship over the last 3 years. And that the market seems to have gotten into its head that, all right, interest rates go up, tech stocks suffer. It's only a small part of 3 years that's been true. It's been completely false for the 10 years prior to that. So given that they have been beaten up so far as rates have backed up, it makes me feel like, gee, this has gone a little too far. Now, that's not a full-blown endorsement of tech stocks. They could go down for a bunch of reasons. If we see much more regulation in the United States and globally against big tech from legislators, from antitrust enforcement, then certainly, the sector's vulnerable to that. And they could go down because of that. They may underperform because of that. But I don't think they're going to underperform because of higher rates.